Right now, somewhere in the world, a financial shock is already forming. It could be a geopolitical conflict, a disruption in energy markets, a sudden loss of investor confidence. And when those shocks hit the financial system, markets react fast. Stocks drop, currencies move, investors panic. The problem is not the crisis itself. Crises have always existed. The real problem is that most people only start thinking about their money after the panic begins. By then, the damage is often already done. So the real question isn't whether the world becomes unstable again. It's this: when it does, will your money be protected? Why global crises shake financial markets? Global crises rarely stay isolated. Financial markets are deeply interconnected. Energy supply affects inflation. Inflation affects interest rates. Interest rates affect stock markets and housing. For example, when geopolitical tensions threaten oil supply, energy prices can become volatile. That volatility spreads through the entire economy. Companies face higher costs. Consumers spend less. Investors become cautious. When uncertainty rises, markets often react quickly, not always rationally, but quickly, and this is where many people make their first mistake. The first big mistake: panic. When markets fall, people panic. It's a natural reaction. Seeing your investments drop can trigger the same stress response as physical danger. Behavioral economists have studied this for decades. Humans tend to feel losses more strongly than gains. This is known as loss aversion. Because of this, many investors sell their assets at the worst possible moment, when prices are already low. Historically, panic selling has often locked in losses that might have recovered later. This doesn't mean markets always bounce back immediately, but emotional decisions during volatility often lead to worse financial outcomes. So the first rule during a crisis is surprisingly simple: don't let fear make the decision for you. The second mistake: going all in on one asset. Another common mistake is concentration. Putting all your money into one asset, one stock, one cryptocurrency, one sector. When things are stable, concentration can feel exciting. But during crises, it becomes dangerous. Mainstream financial research consistently shows that diversification reduces risk. This means spreading investments across different types of assets. For example, stocks, bonds, cash reserves, sometimes commodities like gold. The goal isn't to eliminate risk completely. That's impossible. The goal is to avoid a single shock destroying your entire portfolio. Why liquidity matters. During a crisis, access to cash becomes extremely valuable. This is called liquidity. If all your money is locked inside long-term investments, you may be forced to sell them at bad prices when you need cash. That's why many financial planners recommend maintaining an emergency fund, often several months of essential expenses. This buffer allows you to survive financial stress without touching long-term investments. It also prevents emotional decisions, because when you know you have time, you think more clearly. Where investors often move during uncertainty. When global uncertainty rises, investors often move toward assets perceived as safer. Historically, these have included government bonds from stable economies, cash or short-term instruments, gold, which has long been viewed as a store of value during uncertainty, and sometimes sectors tied to essential resources like energy. This doesn't mean these assets always go up. Markets are complex and unpredictable, but historically, capital often shifts toward stability when risk increases. The strategy many long-term investors use. One strategy frequently discussed in mainstream investing is gradual investing during volatility. Instead of trying to perfectly time the market, investors add money in small amounts over time. This approach is often called dollar-cost averaging. The idea is simple. When prices are high, you buy less. When prices fall, the same investment buys more. Over time, this can reduce the risk of entering the market at a single bad moment. It's not a guarantee of profit, but it can reduce the emotional pressure of trying to predict the exact bottom. Crises feel chaotic. News becomes dramatic. Markets move fast. Fear spreads quickly. But historically, financial systems have always gone through cycles. Booms, slowdowns, recoveries. Investors who survive these cycles usually follow a few consistent principles. They stay diversified. They keep liquidity. They avoid panic decisions. And they focus on long-term strategy instead of short-term noise. The next global crisis might come from many places: geopolitics, energy markets, debt problems, or something nobody expects. No one can predict the exact trigger. But preparation doesn't require prediction. It requires discipline. Because when uncertainty arrives, the people who stay calm, diversified, and patient are usually the ones who protect their wealth the best.